Today we're starting Unit 5. This will be our last unit for the semester. So there will be 4 sets of notes for this unit. So in this unit we're looking at the 1930s, focusing on the Great Depression and the New Deal. So these notes are titled The Great Crash. So first, before we talk about the Great Crash with the stock market, it's important to understand what stock is. So with stock, you have investors. They're people, they have money. They want to invest in companies like Apple, Google, Disney, Verizon, any companies that are public you can invest in. And so in turn, so they will invest their money, give it to a company. In return, the company gives them a stock certificate. So all companies, their stocks vary in price. So depending on how much money you invest, the more stock you can buy. And essentially that makes you a part owner of a company because you have now invested in them. And so if that company makes money, you will now make money based on the percentage that you've invested. If they lose money, you will also lose money. So ideally the way investing in a stock would work favorably would be you invest in the stock, they give you a stock certificate. The company then uses the money to hire more people, buy new resources, create new products, and ultimately making profits. So then those profits are shared with the investor. Other people began to see like, hey, I want to get in on this deal. They want to invest too. So people start to, get this snowball effect going. So then the original investor gets their money, the new investor gets stock and has to wait for profits to be made. So essentially when people buy stock, they're investing in a company and they will make money if the company makes money. But if the company loses, like if you had invested in, Blockbuster Video, it's no longer around, you wouldn't have money. But if you invested in, Apple in the 1980s and they're a huge multi-billion-dollar company, you have a lot of capital now. Okay, so by the end of the 1920s, something was terribly wrong with the U.S. economy. Prices were rising fast, but wages were stagnant. They were staying the same. Consumers began to reach their credit limits and spending began to slow down. Slow sales meant U.S. firms struggled to make profits. So this leads to an artificial prosperity. So throughout the last unit, I kind of hinted that yes, it was boom times, businesses were doing well, but most people were buying stuff on credit, and that makes a big difference. So here are some signs that the 1920s bubble was about to burst. Key industries were in trouble and weren't making profits. Industries like coal, oil, steel, textiles, housing, and auto. Farmers were struggling to survive. Failing crop prices made it difficult for them to pay off debts, make money. Farmers eventually lost homes. Rural banks began to fail. Consumerism grinds down to a halt. So consumers ran out of disposable income and credit, so purchases slowed. And this makes a big impact because if people aren't buying things from businesses, then businesses aren't making money. They can't pay their staff. And so we start to see this cycle happening. Rising debt. Both consumers and firms spent beyond their means and ran up unpayable debts. There's also an uneven distribution of income. So the prosperity of the 1920s hit a vast inequality of income. Only a very small number of Americans actually prospered during the 1920s boom. So the wealthiest 1% saw their wealth grow 75%, and while most only saw their wealth grow 7%. So it's that old saying of the rich are getting richer, and so they're buying 2, 3, 4 more houses, while the regular average working class person just kind of like made an extra paycheck. They made a little bit of extra money, but nothing significant to like bump them in their social class. Where like the wealthy are getting extremely wealthy, so that income gap between them is getting larger. So significance of this: more than 70% of American families lived at the poverty line. Most couldn't afford basics. didn't save money for a nest egg, and used credit to get by. So here we have a pie chart kind of showing where people were. So 65% of Americans made under $2,000 in the 1920s. About 29% made between 2,000 and 5,000, and then 5% made 5 to 10,000, and then 10,000 and over was the 1%. So again, if it was equal, each of those colors should have an equal share. Shouldn't be so disproportionate. In addition, Americans looked for quick riches in the stock market. So risky stock market practices. People invested in the stock market looking for quick wealth. During the 20s, deregulation of markets and pro-business policies had eased rules. Harding and Coolidge, presidents in the 1920s, had recklessly eased government regulation that allowed risky stock practices. So speculation. Investors bought stocks based on hopes for a quick profit, not on merits of the firm. So most people, when you invest in the stock market, it's seen as a long-term investment because your profits will grow with the company. And so very rarely do companies have like the next month they're making all this profit. Companies grow, they expand, and so over time they get bigger. So you see this as, I'm going to invest now, and maybe in 5 years, 10 years, 15 years, you start to see returns on your profit. So the stock market was never really meant to be gambled with, which is what people are doing. They're hoping to put money down this week, next week take it out, and so that's where problems come in, and speculation, where speculation starts to mess with the stock market. Also, people were buying on margin. Investors bought stocks with a small down payment and paid the rest with credit. So they were borrowing money from the bank to invest in the stock market. So their hopes was that they would make money. They heard about a really great stock. It's going to double their money in a week. They would invest. Once their money was doubled, pull the money out, pay the bank back what they borrowed, and everything was fine. The problem will happen when the stock market starts to drop. And these people that are buying stocks on margin or credit, borrowing from the bank, when they lose their money and they can't pay the bank back, that's where the issues start to happen. So what we see happening right now is that people are not making wise decisions investing in the stock market, and it's causing a lot of instability. Next, let's look at the recipe for economic collapse. So all of these things were happening to contribute to the start of the Great Depression. We will talk right now about the Great Crash, the stock market crash. And so while a lot of people feel that that is what caused the Great Depression, it is just one of many factors that were happening. So all of these other things were happening in conjunction with the stock market crash that led to the Great Depression. So we had a vast income inequality among consumers, so a huge gap between the rich and poor, or even just rich and middle class. Key industries were struggling to make profits. 70% of consumers were living at the poverty line without safety net savings. So if someone were to lose their job, they had no money to fall back on. Consumer spending was grinding to a halt, so people weren't buying things, businesses weren't making money. Farmers were unable to pay debts. Often their farms were being foreclosed on, so they lost their property. There was an overuse of credit to meet needs, and risky stock investments. So now let's look at the symbolic start of the Great Depression, the stock market crash. Most historians will mark the stock market crash as the beginning of the Great Depression. So again, not the cause, just kind of seen as the official start to the Great Depression. The market begins to crash. Only 3% of Americans actually had money invested in stocks, so it was a very small percentage. But we will talk about how the stock market does have long-lasting effects into other areas of life and how it impacts other people, even if they didn't invest. October 1929, rumors began to spread that big investors were ready to sell their stock. So if they were going to pull their money out, that would mean price of the stock would drop, and people wouldn't be able to make as much money. So people began to be kind of panicked and paranoid about the stock market. Market confidence began to stumble. Investors hurried to sell their stock to avoid losses. So October 24th, 1929, panic investors sold their stocks in mass numbers. As stock prices sank, wealthy bankers bought bad stocks to stabilize the market. So as people were selling their stocks, wealthy bankers saw the panic. They decided to invest their own money to try to bring up prices and make it so that people weren't so panicked and to stop the sell. And so it worked for a little bit on that Friday. But then the next week happens. We have Black Tuesday, October 29th, 1929. When traders returned to the exchange on Monday, the bottom fell out of the market. October 29th, 1929 is known as Black Tuesday. It was the worst day of the crash. It saw the biggest drop in stock prices. Panic overtook investors as they dumped 6.4 million shares and stock prices sank. So you see this picture of people on Wall Street, investors going to try to sell their stock, trying to salvage what they had, just confused over what was happening, wanting to be there. By November 1929, the market had lost $30 billion. U.S. output was cut in half. So here's a little graph to kind of show you the stock market. And so we see in the 1920s, stock prices are going up, continuing to climb, very, very high. And so probably this is more evident to stock speculation, people investing in the market to make money, but not showing actual growth of companies. Then as people begin to pool their money, you have the huge drop with Black Tuesday. And so a little bit of confidence starting to go up, but what's important to know is that this was not the lowest point of the stock market. It continues to drop throughout the early 1930s, and in 1932-33 it's hitting a market low. So this is the end of the notes. In the next notes, we'll talk about how the stock market crash begins to affect other aspects of American life, and how the government decides to deal with this economic crisis. So the notes are done. You can work on your key terms for this unit.